Good morning and welcome to another edition of the Main Management Weekly Market Note for February 6th, 2026. As usual, I am Alex Varner, our head of research here alongside
James Maxwell, SVP of Research.
Let's get into it. We had the kind of very short government shutdown that resulted in jolts coming out a day later, and then non-farm payrolls got bumped to this week. So we have the holy trifecta of data of retail sales, CPI, and non-farm payrolls this week. So we were bracing for those releases. But in the meantime, on the performance side of things, year to date, things are more up than down, I guess. On the sector side, energy's up the most, up 19%, while tech comm services are down the most at 1.7 and 2. And then on the sector for the week, we had staples, industrials, materials leading the way, consumer discretion, and comm services down the most. And then NASDAQ and the S&P were down on the week as well, and commodities had a bit of a pullback.
One thing I'll say on this, we've kind of continued to see week over week, we've been calling it internally like some sort of rotation under the covers of the market on the sector side, at least, especially. You've seen kind of these hard asset, energy, materials, industrials, very cyclical, kind of pro-cyclical industries or sectors continue to do very well. Year to date, those are the ones leading. And then on the laggards is a lot of those more traditional tech, asset light, as we've called them, kind of high margin businesses that have been lagging. So that's like your software companies. Obviously, that's been a major loser, but even broader tech and communication services, et cetera.
Yeah, definitely seeing a rotation in here. On the recession dashboard, not a ton has changed from the prior week. Things more positive and kind of middle of the road there. On the JOLT, so the job opening and labor turnover survey, openings fell to just 6.54 million. That's the fewest in September of 2020 and well below forecast for a 7.2 million figure. Hires ticked up to 5.3, basically range bound over the last, 2.5, 3 years here. And on the right, you can see the month-over-month moves. Over the last 3 months, openings have fallen by a combined 1.12 million. And over the last 12 months, they were down 966,000.
Wow.
So basically, a million openings have kind of come off out of the kind of labor market. Again, this seems more kind of moderation, still recovering from the huge swings during the pandemic. If you draw that blue arrow even further across, you can see, we're a little bit below where we were pre-pandemic, but in 16, 17, we're right in line with those numbers. So not like a huge kind of disconnection between where we were prior to the pandemic and now. But I think it's just continued moderation. You can see that here as well in the quits and the layoffs. Quits ticked up to 3.2 million. That's a 6-month high. They've risen in the last 2 months after hitting a post-pandemic low of basically under 3 million back in October. So that's usually a good sign because workers are more likely to quit when they think they can find a job elsewhere, which is kind of contradictory with the fall in openings. So there's fewer openings and yet more workers are quitting. But I guess they're seeing something out there that they're okay with. And then, we have the layoffs there. Those ticked up, but again, kind of range bound as they're grinding back towards pre-pandemic levels. And on the right, we show the ratio of openings per unemployed person. That fell to 0.87, which is the lowest since March of 2021. But again, still above the long-term median. This has actually been negative. But below 1 is indicative of more openings than unemployed people. More unemployed people than openings. So below 1, that's usually the norm. So we're getting back to that still, again, as you can see the unwind here. Ongoing moderation. We got ADP payrolls. This was in place basically, alongside non-farm payrolls that are coming out this week, but this was the private data that got released. So there are no delays here. But payrolls were up 22K in January, basically half a forecast for a 48,000 reading. On the right, you can see the kind of breakdown across sizing. Medium firms drove the headline figure, adding 41,000. Small firms were flat at 0, and large firms shed 18,000 jobs, which is the biggest monthly decline since April of 2025. And you can see here on the left, this is the share of ADP payrolls by size. So small firms are far and away the main employers, 44.4%. Medium are next at 37.4%, and then the big firms are only 18%. That is basically their second highest level ever, though, as far as share goes of the total employment. It's about to surpass that kind of post-COVID peak of 18.3%. And then on the right, you can see the year-over-year figures basically trending down. We are below pre-COVID levels here. I think a big issue, again, goes to the composition of the labor force where you've got AI is causing some stuff, but the bigger thing on top is migration or
Yep.
immigration or lack thereof, and you don't have those jobs being added. So that's why the year-over-year figures are slowing more than they kind of had traditionally have been. But small firms are up 0.5, medium are down 0.5%. Maybe they're trying to put in a
Mhm.
bottom and kind of get back up to break even, and the large firms are up the most at basically 1.06%. But again, still slowing. The job cut announcements from Challenger, Gray, and Christmas started off on not a great foot for January. They came in at 108,435 job cuts versus 5,300 hires. That's the biggest January cuts figure since '09. If you remember, 2025 was the first year in which we had more cuts than hiring announcements for a full calendar year. So this is continuing that trend. But again, JP Morgan and a couple other places noted that this figure might not be as bad as it appears because you had potential double counting from Amazon layoffs where they announced 30,000
Mhm.
a couple of months ago. And then you've seen 14,000 and 16,000 show up in the last 2 months, and that adds to 30. So it's like they
Mhm.
already got that 30. They just got 14 and 16. So are they double counting that? But either way, still it's a solid January for cuts. Not a great way to start off
Yeah.
the year on that foot. Where and why on the left you can see by industry. Transportation was the most. That was UPS, 30,000 cuts from UPS. And then you have technology next at 22,000, 291. Again, potentially inflated due to that Amazon number. And then as for why are people cutting, contract loss and market conditions, both right around 30,000. Those are the two highest or most cited reasons. Interesting to say AI in there at 7,600 cuts, and then Doge showed back up. And it's like it's Doge
Mm.
downstream effects. But again, that was like a zero number for the last
Yeah.
3 months. So I don't know where that kicked on from, but there you have it.
Yeah.
back in the headlines. We also got manufacturing PMIs on the US. You can see the S&P figure, ISM and Chicago. ISM and Chicago surged in January to start the
Mhm.
year. ISM's at 54, Chicago's at 52.6, which is good. They're both back in expansion. S&P ticked up to 52.4. That ISM figure is the best since August of 2022, and Chicago is the best since November of 23.
Mhm.
So some multi-year highs here, which is good. You want to see
Yeah.
the kind of manufacturing economy kicking back up into expansion territory.
Yeah. One thing I'll say on this, and you've kind of seen this in a number of other indicators as well. Obviously, the PMIs are tied to kind of the cyclical economy. They're
Hmm.
known as leading indicators for the cyclical parts of the economy, that those manufacturing parts. One thing that's kind of interesting to me is you've seen I mean, one thing you can look at is like the economic surprise index
Yeah.
has continued to kind of pick back up. One that's part of the reason why I think these more pro-cyclical sectors have actually been leading. I think that's the market reflecting what's going on in the economy kind of side by side. But what we just were talking about, the labor market, that's been much less constructive. So,
Yeah.
JOLTS was obviously a couple months delayed here, or month delayed here, but that was relatively weak, kind of on
Yeah.
the margins. ADP weaker than expected.
The
The
non-farm
cut,
payrolls for this week are consensus is 70,000, but it seems like a lot of people are taking the under.
yeah, yeah. Like there's all sorts of things in the labor market that don't seem great. It just kind of seems at best just
Middling along.
middling
Yeah.
along. One positive though, or kind of silver lining on that, the labor market in general is known as a pretty lagging indicator.
Hmm.
It's not the first thing, the first domino to drop by any means.
Yeah.
So the fact that it's weaker might be reflecting kind of the economy of 6 months ago
Yeah.
versus the PMIs, these more leading indicator measures are actually picking back up. So maybe there's some kind of cycle under the covers there where actually the economy is showing more signs of growth.
Yeah.
That's why you've seen the pro-cyclical sectors, you've seen the PMIs, you've seen these other things, even if the labor market's been
Yeah.
weak-ish.
Yeah. Yeah. I agree on that. And you see that also in the Q4 GDP
Yep.
figures, Q1, those are strong
Yep.
numbers. So it is kind of hopefully a delayed market on that labor side of things. And it'll start to kind of maybe strengthen a bit
Yep.
as we go into the year. Kind of back on this manufacturing PMIs on the right there, you can see the ISM components. They were all higher. Only two are still in contraction, which is employment and inventories. But
Mhm.
again, you can see they're pretty solid hooks up this month to start the year off. And then on the global side of things, basically almost everything moved higher. On the left, you can see the global manufacturing PMIs. On the right, we're showing within Europe. Only a couple of spots of weakness in there. We won't go into every single country. You can read it there for yourself. But on the global side, U.S. was up, as we said. China was up. J.P. Morgan Global Index was up since best since May of 24. Japan jumped to 51.5, which is its best since August of 2022. Euro area ticked back up to 49.5, and the BRIC average up to 50.5. So again, things generally moving higher to start the year off. You saw similar figures in the service and composite numbers as well. We don't touch on those here, but it's good to see. Oh, just kidding, we do. You can see the services on the left here, and the composite numbers were a little bit more mixed. They were kind of more up than down, but you had a couple more down items there. Services side, US improved to 52.7. That's revised up from the flash, 52.5, but you came in slightly below forecast for 52.8. But again, like 0.1 on these is not it's basically a rounding error. China was up to 52.3, JP Morgan Global Index up. And then on the downside, Eurozone was down, and the BRIC average fell a little bit on the services. And then for the composite figures, US was up, China up, JP Morgan Global Index up, Japan up, BRIC up, and Eurozone down. But again, those are all in. You can see every figure on here on these two charts is in expansion above 50. So that's a good sign. Things are chugging along on the service and composite. And from a sizing standpoint, at least in the US, the manufacturing market is 15%, like 12% of the economy. So it is, they pay more attention to the manufacturing numbers because they've been out for a very long time. But the services and resulting composites are dominate the market share as far as kind of the breakdown of the economy goes. We have a couple of sentiment indicators to close out. So we got the RC, Real Capital Markets, TIPP Economic Optimism Index. That moved up to 48.8 in February, the best since August of 25 and ahead of forecasts. Personal Financial Outlook is up to 56.9. Support from federal policies moved up to 45.7. That's a 4-month high. And the 6-month outlook ticked up to 43.8. So positive across the board for this RCM TIPP index. And then we also got on the left here, Michigan sentiment improved for the 3rd month in a row. That's the longest streak since August to December of 2024, 3 months in a row of increasing. So you can see here, maybe, but it's still down. Headlines at 57.3. Current economic conditions up 58.3, and then consumer expectations actually ticked down to 56.6. But you see on the right there, those are the inflation expectations. And a lot of this consumer sentiment, we've touched on this, is tied very strongly to inflation and inflation expectations. And you saw the 1-year fall to 3.5, which is the lowest since January of 2025. While 5-year expectations ticked up to 3.4.
It's funny, both those sentiment readings kind of tie into what I was referring to, this broader kind of maybe green shoots within the economy of just better than expected. Obviously, Michigan's still in the dumps in terms of sentiment, but on the margins, improving. Then the economic optimism obviously done pretty well.
And you've seen a kind of a breakdown in the correlations between like investor sentiment and consumer sentiment. Where the market side of things, market participants have been more bullish, more positive, markedly more positive than consumers have. So there's definitely a difference in kind of the way those two groups are viewing viewing the economy and feeling things. But that basically wraps it up. In summary, JOLTS saw openings fall to 6.54, the lowest in September of 2020. ADP payrolls up less than half of expectations at 22K. Job cut announcements started the year off on the wrong foot at 108,000. Again, potential double counting, but still pretty high, even if you remove that. Manufacturing PMIs started off on the strong foot as well. U.S. domestically, you saw ISM in Chicago hit multi-year highs, and then service and composite PMIs were more up than down, ongoing steady expansion there. And then you saw some improvement in the consumer sentiment figures that we got from the RCM TIPP and the University of Michigan sentiment readings. Those were more positive. Upcoming data this week, as we mentioned earlier, there is a lot of data out, but we got retail sales, employment cost index on Tuesday, non-farm payrolls on Wednesday. I think CPI has been bumped to Friday, so that differing date there, but you got non-farm payrolls, CPI, and then existing home sales on Thursday. Those are kind of the major data points out. So a lot to digest as we go into this week. Hope everybody had a great weekend, and we'll talk to you next time. Thank you.